Every way to fund a business costs you something: cash, equity, control, or time. We're ranking all of them by what they really take from you. Then, why the exact same menu doesn't cost the same for every founder who orders from it. Think of every funding option as a line on a ledger with 4 possible currencies: cash, equity, control, and time. Say yes to an option, and you're really saying yes to which of those 4 you're willing to spend. Get the ledger right, and the question stops being, "How do I get money?" and becomes, "What am I actually willing to give up?" According to the option most founders actually use, their own money. According to U.S. Chamber of Commerce data reported by Fundable, 78% of small businesses are funded through savings and revenue, bootstrapping, not a pitch deck. Of the roughly 500,000 businesses started in the U.S. every month, fewer than 500 will ever raise venture capital. That's not a consolation prize. It's just the math. The cost isn't cash or equity, it's time, and the risk sits entirely on you. If the business fails, there's no investor absorbing the loss and no bank writing anything off. You absorb it. For most businesses, that's the only round they'll ever raise. A step up from pure bootstrapping, some founders bring in friends, family, or a crowdfunding campaign before they ever talk to a bank. The dollar amounts are usually smaller, and there's rarely interest in the traditional sense. But the currency being spent is different again. It's the relationship itself. A late payment to a bank is a bad mark on a credit file. A late payment to your sister is Thanksgiving. Then there's the option most people underestimate: the business credit card. The Federal Reserve's Small Business Credit Survey found that 55% of small firms used a credit card for financing in the past year, more than double the 26% that took out an actual business loan. The cost here is straightforward: interest and whatever your personal credit takes on if the business can't pay it back. Next is the loan most people picture when they think small business financing: the SBA loan. Here's the myth: the Small Business Administration doesn't actually lend you the money. It guarantees a slice of a loan made by a private bank, which is exactly why your approval still runs through that bank's own underwriting, not a government office. As of July 2026, the SBA doubled its combined loan ceiling to $10 million, and current rates run roughly 9 to 13.5% APR. It's part of a small business lending market on track to hit $850 billion by the end of 2026, up 7.2% from last year. The cost: interest plus a 30 to 90-day wait from a bank that was never actually obligated to say yes. 2 more options sit at opposite ends of the ledger. Revenue-based financing takes a flat cut of future revenue, typically 6 to 12%, and gives up no equity at all. Venture capital and angel investment do the opposite: no interest, no repayment schedule, but you're typically handing over 15 to 25% of your company at the seed stage, plus a permanent seat at the table for someone else's opinion. Same ledger, completely different currency, and a completely different life afterward. One more myth before we move on: that bootstrapping means choosing slow growth forever, and that raising money later means you failed at doing it yourself. In practice, most successful companies sequence these options rather than picking one for life. Bootstrap first to prove the business actually works, then layer in a loan, revenue-based financing, or outside investors once there's real cash flow to negotiate from. A ledger isn't a single choice. It's an order of operations. That's the ledger as it's usually taught. the same handful of doors, open to anyone willing to pay the listed price. Except the data says something the marketing material leaves out. For a lot of founders, the price tag on those same doors isn't the same at all. And that's before you even get to the part where you need money to build the credit history that gets you the money in the first place. And that gap doesn't start at the bank counter. It starts earlier than that. One of the most common questions we found founders actually asking online wasn't, "How do I get a loan?" It was some version of, "Why do I need revenue history to get funding when I need funding to build that revenue history in the first place?" For most founders, that's a mildly annoying chicken and egg problem. For founders already facing a steeper approval curve on top of it, it's the whole game before the game even starts. And this isn't a handful of anecdotes. A national survey, cited by the policy group Third Way, drawing on Federal Reserve data, found that roughly 60% of Black-owned businesses and more than a third of Latino-owned businesses said access to financing was a major challenge, compared with just 29% of white-owned firms. That's not a fringe complaint. That's a majority experience for some founders and a minority one for others, describing the exact same funding system. Here's the myth that the gap is just about credit scores. Fix your credit, and the doors open evenly. Here's the reality from the Federal Reserve's 2026 Small Business Credit Survey. Black-owned businesses face loan denial rates as high as 39%, compared with 18% for white-owned firms. And that gap holds even after controlling for creditworthiness, revenue, and how long the business has been running. At large banks specifically, only 16% of Black applicants got the full amount they asked for, versus 48% of white applicants, and 48% of Black applicants at those banks got nothing at all. Fewer existing banking relationships and less available collateral compound the gap on top of that. It isn't one factor, it's several, stacked. The pattern isn't unique to one group. Stanford's Latino Business Action Network reports that only 21% of Latino entrepreneurs get full funding for their ventures, compared with 40% of white entrepreneurs. And for loan requests over $1 million, that gap widens to 22% versus 45%. It gets worse when a loan is denied. Only 51% of Latino applicants ever get an explanation why, compared with 87% of white applicants. Denied, and often not even told why. Zoom out to venture capital, and the gap becomes a cliff. Crunchbase data shows only 0.32% of all U.S. venture funding went to startups with a Black founder in 2025. Even at its 2021 peak, that share was only 1.5%. Latino founders receive under 2% of all U.S. venture capital, and their share of early-stage deals actually fell from 2.6% in 2020 to 0.6% in 2025. If venture capital is a door at all for most founders, for these two groups, it's barely cracked open. This isn't abstract to the people living it. Funleo Alabi, CEO of Shea Radiance, put it plainly. As a woman of color, and an immigrant, the doors to financing are not always wide open. William Towns, who teaches social impact at Kellogg and works in impact investing himself, argues the fix has to include the institutions doing the lending, more diverse board representation, and real change inside the banks making these decisions, not just better prepared applicants. So here's a myth a lot of founders have been sold. that there's a federal minority business grant waiting for them if they just find the right application. There isn't. The Minority Business Development Agency doesn't hand out grants directly to businesses. It funds business centers that offer consulting and connections to capital. Most real minority-focused grants actually come from a scattered mix of private, nonprofit, and state programs, which is exactly why so many founders assume the whole thing is a scam. A rough rule of thumb: a legitimate program never asks you to pay upfront to unlock grant money, and it's verifiable on a .gov domain, a known CDFI, or a named nonprofit, not a form that showed up in your inbox. But there is a real door here, and most founders just don't know its name. It's called a CDFI, a Community Development Financial Institution. Unlike a traditional bank, a CDFI exists specifically to fund what banks won't. Data from the Opportunity Finance Network's CDFI Coalition shows more than 65% of CDFI loans go to minority-owned businesses, and 85% go to businesses in low-income areas. The underwriting looks different, too. CDFIs are built to weigh character, community ties, and business plan alongside the numbers, not just a credit score in isolation. It's not a myth, and it's not a grant. It's an actual lender, built for exactly the gap we just spent the last few minutes measuring. The Minority Business Development Agency itself puts a number on what's at stake: a $6.3 trillion opportunity gap between minority-owned and non-minority-owned firms, and closing it, by their own estimate, could add 20 million jobs to the U.S. economy. That's the actual size of the door still sitting closed. If you take one thing from this video, before you walk into a bank, search CDFI near me or MBDA Business Center for your state. It costs nothing to ask, and it's a door most founders never even knew existed. Every funding option on this list costs you something. For some founders, it's just cash, control, equity, or time. For others, the system quietly adds a surcharge on top of that ledger. And the first step past that surcharge is knowing it's there, and knowing exactly which doors are actually built to open for you. If you want the real terms behind funding decisions, not the marketing version, subscribe. That's exactly what we break down here.